Okay, welcome everyone. So once again, really excited and would like to give thanks to Philip Futures for having me again, giving me this opportunity to share about what I know about the financial market. Okay, and of course, hopefully you guys will be able to benefit, find value out of this sharing. Okay, so I'm pretty sure you guys would have perhaps questions, things that you'd like to clarify throughout the webinar. Okay, I've allocated time for Q&A at the end. So as I'm sharing throughout this presentation, I might not be able to look at your questions immediately. So do keep your questions all the way back until the Q&A. All right, but I hope you do have your writing materials prepared because there will be definitely things that you would like to note down. Okay, so very quickly, today's topic, of course, is the 2021 Q1 market outlook. And I think, while every start of the year, we like to talk about the market outlook, right? But I personally feel that 2021 is a very unique year. I would say, in fact, since 2020 is already a very unique year, simply because, we have COVID, we have pandemic, and then we know that generally most banks are already in QE mode, right? In easing policy. Okay, so moving forward, 2021 this year, 2022, I think it's a very, very interesting period that, yet at the same time, very important that you are aware of what's happening, right? That's why this webinar is really designed for that. Okay, so a very quick introduction about myself. I think it's very important that you also know a little bit about me, because if today you have invested your time to listen to this webinar, I want to make sure that you are, number one, focused, number two, you're committed to it, and that to help you do that, okay, I need to quickly introduce myself. Okay, so I started trading investing back in 2012. And of course, before the pandemic, before 2020 lockdown, I've also traveled across various cities to do sharing. Okay, so these are just some photos. Of course, right now we do a lot online, right? And I would also like to quickly share with you some of the practical results that I've been using the methods, using my knowledge to trade and invest in the market. And these are real results that I personally have. Okay, so it's something that I feel important because what I'm sharing with you are not just theory, right? It's not just from the books or the internet, but are really things that I've personally applied into my own trading investing journey. Okay, so I trade the FX, so you can see this is my 2019 results for FX market. Of course, that's like some time back already. Okay, this was last year result. Okay, you can see it's not as smooth sailing. There's like a down month here in May, pretty significant. Okay, but overall, the year in 2020, my FX portfolio is able to grow by about 8.5% in total. Okay, and last year, this is my stocks portfolio as well. I think last year's stocks was pretty easy, right? And the return here was 36%. Okay, with a maximum loss was March, where you see that dip, right? In the stock market, my portfolio dropped by just about 1.55. Okay, so this is a quick one about me. If you guys would like to maybe connect further up beyond this webinar, right? Feel free to just connect with me on social media like Facebook and Instagram, right? Just search my name, you'll be able to find it. Okay, so that's a very quick one about myself in this webinar, right? So let's talk about what you want to take away from this webinar. Number one, okay, you'll be able to identify, and of course, I'm going to share with you what is the global macro environment right now in 2021. Okay, and this is something that I believe not a lot of traders or even investors would really talk about publicly on social media, because it's something that not everyone track, and I think it's not it's not as sexy as like looking at charts and things like that. Okay, but to me this is very important. Okay, and therefore I want to pass this information to you guys as well. Okay, and of course we'll definitely talk about opportunities that you want to keep a very close watch to. All right, and these are definitely profitable opportunities you want to keep an eye on, and of course why you want to focus on commodities. Okay, this is in line with what's happening right now globally, so that's why I want you to understand the global macro first. Okay, and then we'll go into why we are looking at those opportunities, right? They are linked. Okay, so to me, I believe it's important that you know the reason. Okay, so this is for you, whether you're very new or you have been trading investing for some time. I think whatever I'm prepared to share with you in this webinar is definitely going to benefit you. Okay, now if you're very new, don't get scared of like, wow, is something going to be very complicated and things like that. Now the concept might be sophisticated, okay, but what my role here, of course, today is to break down those complexity and make sure that you understand by the end of today, okay? So don't be afraid of it, even if you're very new, okay? And if you have some experience in the market, definitely this is something that will be able to help you. Okay, and of course, I've prepared that to pass you guys all the slide deck, and of course, including some of the key opportunities that I've included in this slide deck. So you do not need to, worry about needing to like screenshot, and copy down everything. Okay, just do take notes. Okay, but the slides will be given to you at the end of this session. Okay, so let's get started off with. I want to give you, a kind of like food for thought, right? Now, we experienced this, okay, back in 2020 March, we saw the economy suddenly gets locked down, right? Every country went into lockdown. Employment rate went down, unemployment hit all-time high, and of course, a lot of businesses went bankrupt. Okay, but you realize that yes, the stock market has a kind of knee-jerk effect, March it dropped, but last year it closed all-time high, right? So the idea here is that economy hasn't really recovered, it's still bad, but at the same time the stocks are rallying. Okay, have you ever really wondered like what is the reason behind it? Okay, now some of you might have the answer, okay, but I'm quite confident that many of you perhaps are not aware what's driving this, right? What's the reason behind stocks still rallying? Okay, and in short, the answer is what we call liquidity. Okay, now liquidity is a very big word, but if I were to just simplify this word here, right, to give you the understanding of it, it's just basically how easy money is flowing. Okay, and when we talk about liquidity, I need to bring in this person here called Stanley Druckenmiller. Okay, so he actually has this quote that says that whatever I do, okay, I focus on the central bank and I focus on the movement of liquidity. Okay, while what he says is that most people in the market tends to look for like earnings, conventional measures, that's of course including your various indicators, technical analysis and things like that, right? He says that it's liquidity that moves the market. Okay, so this highlights that it's very, very important. Okay, so it brings us back to like March 2020. That's exactly the most recent case study that you can actually take out, right? Where the economy is bad, but the market actually recover very, very fast. Why? Because of liquidity. Okay, so what is liquidity? Just now I mentioned, right? Liquidity is in the simplest way to understand how easy money is flowing. Okay, and over here, what is this money we are talking about? It includes both cash and credit. Now, I think cash, every one of us understand that, right? Basically, your notes, your coins, those are cash. Okay, now credit is a little bit, I would say, maybe sophisticated in a way. Credit over here, we're referring to, it can be like a loan. Okay, it can be just basically a contract where, it states how much I owe you and such like that. There's no transaction of real tangible money yet, but that's also liquidity. Okay, now if you think about it, the creation and the destruction of credit is actually the easiest to create because you don't need a cash. Okay, so for example, today, right, you just write a simple note, okay, to your best friend and say that, okay, in 2 years or maybe in 2 months time, I'm gonna pay you $10,000. Okay, you just write a note and you pass this note to your friend. What will your friend feel? Your friend will instantly feel, wow, I'm richer by $10,000, even without really, receiving the cash yet. Okay, of course, it's a bit exaggerated. Okay, but I want you to imagine that. Okay, instead of you, what if it's a company? Okay, something that is a little bit more trustworthy, a little bit more tangible. A company write you a note and say that in the future, I'm going to pay you $10,000. Instantly, what you feel like, I'm $10,000 richer, even though you haven't really seen the money yet. Okay, and that's what we call credit. So it's very easy to create, right? Anyone can literally do it with a certain trustworthiness. Okay, so to understand credit, to understand liquidity, then we need to understand who can create it. Of course, the example I gave you just now is a little bit exaggerated. We as humans, normal people, won't be able to do it. Okay, but generally there are 3 levels of liquidity. That means these 3 players are able to create liquidity, right? Can create cash, can create credit. So the first one, of course, is the central bank. And I think by now, if you have been trading and investing sometime, you know that central banks literally can go into quantitative easing. Okay, QE, and that's equivalent to like printing notes, okay, really printing money. Okay, you do have government, which is coming in the form of like fiscal policy. Okay, and this one here will definitely talk a little bit more as we progress in today's webinar. And of course, the last one here is companies, right? But companies play a very minor part. So if you really want to understand the big picture, the macro perspective of the financial market, then you need to really pay attention to the Fed. Okay, why the Fed is because right now US dollar is still the global reserve currency. In other words, everything deals with the dollar right now, right? And the Fed is the central bank for US. It controls the US dollar, right? So this is right now one of the most crucial player that you want to keep an eye on if you want to understand macro environment. Okay, so the Fed literally drives liquidity, right? And just now I talked about monetary policy, basically printing money, playing around with interest rates will be able to drive economy. Okay, and naturally, I want you to know that before last year, okay, so that's why I say this is very important. Before last year, the Fed has two main kind of like target. Okay, so this is like their KPI. Okay, so the Fed has two. One is full employment. Okay, so you actually can see over here, right? Maximum employment, full employment. The second is of course inflation target. Okay, so the Fed has always set an inflation target of 2%, which means that they want to see a steady growth in the economy, growing by 2% annually, right? So that's their KPI. And the idea here is, of course, they need to adjust their interest rate and the money supply. These two things is the monetary policy. They need to adjust this according to how the economy is doing so that they can hit their KPI. Okay, so if of course you know, when interest rate goes up, it means that today if you're a business owner, you want to borrow money, it's a little bit more expensive because the interest of you paying back the loan becomes higher, and then what will happen is businesses will be a bit more prudent, will be a bit more careful in loaning money and spending money. Okay, so that actually lower your spending, and the economy will start to slow down. Okay, and vice versa, right? The opposite is true as well. Okay, so this is a very quick kind of like flip chart, or I would say a chart to show you how the Fed will actually play around with their monetary policy and what they will do when the economy has certain effect. Okay, so it starts of course on the top left over here when the Fed lowers interest rate. Okay, so I want you to just think about what happened exactly right now, very recent, right? In March last year, what did the Fed do? The Fed actually lowers interest rate. So when they do that, I want you to imagine why. Okay, so what's the reason for them lowering interest rate? It's so that they can lower the cost of borrowing. Okay, which means that your loan, your credit becomes cheaper. Okay, and that would generate demand because again, supply and demand, when price drops, your demand will also be increased. So when there's more demand, there are people borrowing money, spending more. Okay, that actually leads to increase in asset prices. Okay, now asset prices here, of course, we are also talking about your stock market, right? Because when business actually earns more, they profit more, they make more money, okay, and then the outlook of these businesses are better, what will happen is that investors will then invest in them, and the asset prices, including the stock price of these companies, will start to increase. Okay, so again, all this leads to higher growth, and then when a company actually makes more money, they will give out more salary, they will employ more people, and naturally when more people are being employed, okay, more spending is going to go into the economy. You can see over here, it builds up the positive sentiment. It's basically a vicious cycle. Okay, and when everyone starts spending, that's where the prices of goods and services increase, and that's what we call inflation. Okay, and to prevent overinflation, okay, so the Fed has a target of 2% every year, right? So to prevent it from going over the 2% target, they will need to stop and control that, and they do the exact opposite, the increase rates. Okay, so I want you to fully understand this. I think it's pretty straightforward. Okay, why you need to understand this is because before 2020, all the way back in history, the Fed has always been doing these two things. Okay, inflation target of 2%, okay, and full employment. Okay, but what I want you to really take note of is a change in their KPI. Okay, so this is actually released. These texts are basically taken from the Fed statement, right? So it's a bit lengthy, okay, but I will guide you along to where you want to really pay attention to. Okay, so first up, of course, you can see this is released on 27th of August, which is quite recent, okay, from a macro perspective. Okay, and of course you can see some of this cross out. They are not crossed by me. This is exactly the same text that I took from the statement. Okay, the cross out here is basically the change from the start of 2019 to last year August. Okay, so that's the change, right? So whatever is changed, they cross it out. The one that is bold and red in color, they are the newly added text in the latest statement. Okay, so basically I'll just read out. Okay, some of you might understand, some of you might not. Okay, but I'll kind of like simplify it so that all of you understand at the end. Okay, so over here you can see the committee, right? The Fed judges the level of federal funds rate consistent with maximum employment, and of course price stability here is inflation. Okay, and they say that in the long run it has declined relative to its historical average. Okay, so we all know, right? Basically inflation is like almost flat, okay, globally, not only in the US. So that's not a good thing, because if globally the inflation is flat, means the overall global economy is not growing, okay, and that's concerning. Okay, so what they basically say at the remaining text here is that they want to make sure that they can go back and hit the target, okay, of 2%. Okay, and this is the next part, which I think is the most important part that you really want to look out for. Okay, is that in order, okay, this is what they added last year, in order to anchor longer term inflation expectation, which is 2%. Okay, so they say here, right, committee seeks to achieve inflation that average 2% over time. Okay, they judge and say that because inflation in the past has been consistently below 2%, what they want to do right now is they want to achieve an average of 2%. Okay, so if you just think of it, all this while it has been less than 2%, and if you want to achieve average 2%, what do you need to do in the short term? You need to let inflation overrun by a bit to pull up the average. Okay, so just simple math. Okay, imagine like for the past 1 year inflation is 1%, and you want to pull the average to 2%, you need to achieve a 3% inflation, and then you average it out, that's 2%. Okay, so this is important because this is a new tax that the Fed added last year August, which means that they are now prepared to let inflation overrun by 2%, at least for the short term. Okay, so this is a piece of information that I want you all to be aware of. Okay, so in short, okay, for those of you perhaps don't really understand that, this is a very layman term of saying, right? They say that basically the inflation target has been low for the past 20 years. So what we're going to do is we're going to let it overrun a little bit, maybe hit about 3%, 4%, okay, to bring up the average, and then after that we'll think of a way to take care of inflation. Okay, so essentially that's what they're talking about. Okay, now you might feel that that's good, right? Because it means that the interest rate for the Fed will be consistently low, okay, and then that will be good. Okay, yes, you're right. Okay, a low interest rate environment is good for the stock market, but I want you to think about it, that's for the short term. Okay, so I say here all things are good until something bad happens, right? So the idea here is it's good in the short term because right now the Fed is looking to bring up inflation. Okay, so the word here called reflate the economy with massive amount of QE, basically unlimited printing, and a low interest rate environment. Now this is good for stock market. Okay, so this environment, okay, is good for the stock market because why? It creates liquidity, right? Just now we talked about it. If you print money, you bring down interest rate, it brings about liquidity. It's a creation of credit. Okay, this is good. Okay, in the short run. Okay, so as of now, I feel that you know, you guys don't need to panic. Whether is there gonna be a huge market crash? I don't think so. Okay, will there be a correction? Yes, I'll share with you why in a moment. Okay, but I don't think there will be a major crash yet. Okay, but we are very close to that. Okay, so do take note of it. So the idea here is I want you to start thinking beyond just this vicious cycle. Okay, and the question here is what will happen when the next recession hits? So technically 2020 is a recession. Okay, 2008 was a recession. Okay, so let's say we recover by late 22-1 going to 22-2, we recover. Okay, and then I want you to then start and ask yourself, what happens when the next recession comes? Maybe in the next, I don't know, 5 years, 7 years, okay, maybe even shorter. Okay, why I say that is because I want you to take a look at this chart here. This is the federal funds rate. In short, it's just interest rate. Okay, now this is all the way back in 1980s. Okay, and I want you to see where is the general trend of the Federal Reserve interest rate. Okay, it's very obvious, it's a downtrend. Okay, and every recession, what happens? They lower interest rate. And then when the economy recover, because they have an inflation target, right? What they need to do, they need to increase rates to bring back down and control the inflation. And then the cycle repeats. We go into another recession, they cut rate, okay, and then after that they need to hike rate to prevent inflation, and the same cycle keeps repeating itself. Okay, and this is in 2008 when they start to cut rate. But I want you to see every time they do cut rate, it goes lower and lower, right? The high. So right now we are also in the next lower high. Okay, now can you imagine what will happen when the next recession comes? Okay, so the trend here is it keeps getting lower, right? Okay, every time it hikes, it just hikes a little bit and then it needs to cut again. Okay, so same thing here is going to be flat, 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 and then maybe they let it overrun, they hike it a bit, and then what's happened next? They need to cut again. Now I want you to take note, we are already at zero. Okay, and right now the dollar is a global reserve currency. I want you to just imagine for a while if the Fed decides to go into negative interest rate. Okay, in other words, a negative interest rate means that if you hold cash, if you hold the dollar, you are losing money all the time. Essentially, you need to pay back the banks, right? That's called negative interest rate. So as a global reserve currency, if the Fed goes into negative interest rate, do you think globally people will still take the dollar as a global reserve currency? Unlikely, right? Okay, and put that in the perspective of where we are right now in terms of the interest rate. It's already at zero. Okay, and is at the floor, which means that if they want to do another form of quantitative easing or lowering interest rate, there's no more lower ground for them to do unless they consider negative interest rate. Okay, and this is very scary because then leads to the question where in the past few years there's this topic of conversation also, right? Will there be a transition of superpower? Okay, so over here, this is what I'm talking about, right? If the Fed needs to go into negative rates territory, okay, I don't think the dollar is likely going to still hold the global reserve currency, okay, and that brings us to the point where will it be the fall of the US empire and perhaps a rise of another superpower, okay, and of course right now everyone is looking at China, right? Okay, but of course China yuan has their own challenges to become another global reserve currency, okay, but let's focus on the US first, right? And this is something I want you to be aware of. Okay, I'm not saying that this is going to happen in 2021. Okay, but this year itself is where it's unique. Actually, starting 2020, right? It's really unique. So I want you to be aware of all these things that's happening from a global macro environment. Okay, so to bring that into something a little bit more practical. Okay, I want to show you some of the indicators, some of the systems that I personally use to track liquidity. Okay, so why is it important? Now this one here, basically you can see the maximum score is 8. Okay, and of course the minimum is -8, which means that -8 is no liquidity. Okay, very tight. And maximum here 8 means very liquid. Okay, which means good for stocks and the general financial market. This here is December 2020, last year. Okay, so we know, right, it's liquid because the Fed has been printing money, has been cutting interest rate. We saw the stock market rally, right? That's the reason. The market is liquid, so a lot of money is pumped into the stock market. Okay, but I want you to take note of what's happening right now. This is January 2021. Okay, so it's updated as of recent. We have shift from somewhere around 5 to 0. Okay, so not yet to tightening. Okay, tightening means we are going into the red zone, not yet. Okay, but it's more or less like right now neutral. Okay, so you want to be a bit cautious when this happens because it means that we might potentially see a correction in the financial market. Okay, so not yet a crash, but perhaps a correction because liquidity environment has shrunk from 5 to 0. Okay, so this is something I want you to take note of as we progress throughout this entire webinar. Okay, because I'm going to share with you some opportunities later on. They are all related and tied back to the global macro environment. All right, so this is the latest information right now. So for those of you who are very active into like investing in the stock market or trading the stock market, you might want to be a little bit cautious, okay, because of the liquidity environment here telling us that yes, it might have a potential correction coming. Okay, so without looking at technical charts yet, okay, this itself gives us a warning sign. Okay, I'll show you the technical charts in this webinar as well. Okay, so now, knowing that big picture is very important. That is like macro perspective. So it's definitely not going to happen like in 1 month or 2 months time. Okay, but it's very important because that gives us a backdrop of what's going to happen in the near-term future, right? And over here, the question is how will this then affect the US dollar? Okay, so over here, a quick introduction to the concept called the dollar smile theory. Okay, so this is not invented by me. I'm just sharing with you this theory over here. It states that the US dollar tends to strengthen when we are in extreme territory, which means that either the US is very weak or the US is very strong. It needs to be extreme, and therefore the dollar will strengthen. If it's not in the extreme, then very high chance the dollar is going to be weak. Okay, so actually if you observe in 2020, right, we are in an extreme when suddenly everything breaks out, right? The whole pandemic breaks out, everyone starts locking down their economy. That's like panic, okay, and it's an extreme condition. And then what you saw is actually in 2020 the dollar strengthened. Okay, but as we start to see a recovery in the US globally, okay, we'll slowly transit down into this direction. Okay, and that means that the dollar likely will see weakening. Okay, so that's where this theory suggests that. Okay, so if you put that into perspective, right, when the dollar is printing, when the Fed is printing so much money, supply and demand again, definitely a lot of dollar in the economy flowing around, the price of the dollar will come down as well because of supply and demand. Okay, so again, all this are tied in together, right? That's why understanding global is so important. Okay, and with that, okay, I want you to see where the key opportunities comes in. Okay, this is where the opportunities is going to come in for this year itself. Why? Because right now the dollar is the global reserve currency. Everything is tied to the dollar, which means if the dollar is weakening, you're looking at precious metal will rally. If the dollar is weakening, you're looking at commodities market, commodities will rally. Okay, if the dollar is weakening, basically it means that the US economy is not doing very well. Where would the money flow to? It will flow into emerging markets, right? In fact, you have already started to see how a lot of funds are flowing into China. Okay, I have my own personal opinion on investing in China, okay, but that's right now what's happening. A lot of funds are flowing into China, okay, and of course some of it goes into Hong Kong, right, which is the closest towards China. Okay, now over here I also want to highlight to you guys that why this opportunity arises, why the commodities market, right? Again, if you understand global perspective, after the central bank starts to print a lot of money, okay, so if you still remember the 3 layers of liquidity, right? The first is central bank, the second is government. Okay, so why is this important? Is because when the Fed prints a lot of money, right, they know that if they just put the money into the people's pocket, what will happen? They will likely save up or they will throw it into the stock market, right, which is what's happening right now as well. Okay, so they know that people won't spend, and if they give this money to the people directly, it might not be the most efficient way. Okay, so what comes next is the government level. Okay, and that's where you start to see a lot of fiscal policy coming in. Okay, and what it means is that government spending, right? So government will have a lot of infrastructure projects, development, maybe improvement, upgrading. Okay, all these are considered fiscal policy. As long as the government is spending money, it's a fiscal policy, right? And the idea here is the government, where do they take the money to spend? It comes from the bank, right? So central bank prints money, they give it to the government then spend the money on projects benefiting these companies, and then companies will have staff they need to employ, and then that's a cycle. Okay, now think about it. When government spends on infrastructure, spends on upgrading, spends on development, construction, things like that, the commodities market is where it's going to benefit. Of course, that also includes like the precious metal, more on like copper, silver, aluminium, platinum, right? Those kind of metals. Gold itself, it's not really an industrial usage, but at the same time, gold will also rally, right? So I want you to be able to see those connections, all right? So over here, before we go into the commodities analysis on this chart, okay, I want to bring you to the technical side of the things, okay? Why is it still important to look at technical is because global analysis, global macro analysis give us the big picture. But the disadvantage, right, the weakness of it is that it can't really give us the timing element, okay? So technical can give us that, right? Can give us the precision in terms of pricing, can give us the precision in terms of timing. Okay, so we'll talk about the Nasdaq 100 first, okay, which essentially is the US index, right? Of course, you can look at the S&P, you can look at the Dow Jones, but I think they are more or less the same. Okay, so to me, I track the Nasdaq. Okay, now just now we talk about how liquidity environment in 2020 December was 5, and then right now is 0. So there's a fall in it, and we understand that, okay, you want to be cautious, there might be a correction coming. Okay, now if you look at this daily chart here on Nasdaq, okay, those of you who are perhaps a little bit familiar with technical patterns, you'll be able to see that a wedge is forming. Okay, and usually when we see a wedge or an ending diagonal, it suggests that there's a very high chance that we're going to see a reversal. Okay, it's not 100% thing, but it suggests that the probability is a potential correction or potential reversal. Now, adding on to that, I've also included a RSI indicator over here. Okay, some of you are also familiar with this here called the divergence. Okay, so you can see the market is making a new high, but the indicator here is making a lower high. So that's a divergence in two different directions, right? So that tells us again, there's a very high chance we might see a reversal. Okay, so I want you to be able to link, right, not only from a technical point of view, okay, but also adding in the macro perspective. Okay, of course, if you just trade the technical, you will also see that, okay, it's a potential reversal. But where does the global come in? It gives you that conviction level. It gives you that double confirmation, right? So in the market, we are always looking for the extra edge, the extra information, that little bit of extra conviction for us to make a decision. So the idea here is likely we're going to see a correction. Okay, and based on the method I use on technical analysis, which is based on Elliot Wave methodology, there's a very high possibility that the Nasdaq can potentially retrace us towards this level here. It doesn't need to, okay, but I'm not going to be surprised if we see it come down to 10940. Okay, the scale of it is actually pretty much like what we see in March. Okay, so actually, if you just take this, let me do that for a while. Okay, if I were to take this here, okay, and to kind of duplicate it, you can see it's roughly around there, right? It might not be exact. Again, this chart here is not based on the log scale, right? So that makes a little bit of difference, okay? But don't overcomplicate it. But I want you to just see it's roughly about that. Okay, so it doesn't need to do that, but for me, I'm not going to be surprised if I see the Nasdaq actually come down towards 10940. Okay, so again, for those of you who have perhaps a strategy that you can use to trade it to the downside, by all means, okay, you can leverage on that opportunity, make full use of it. For me, I wouldn't be shorting an index. Okay, that's my own personal kind of like approach towards investing and trading. I won't short an index, but when I'm aware of this, that there's a high chance, okay, that this is going to come down, then I will be a little bit cautious in my approach towards maybe buying up the index or even buying up certain stocks. Okay, so for me, I'm using this as a kind of like protection strategy. Okay, but for some of you who have a proper technique to trade it to the downside, then you can use it for kind of like an offensive technique as well, right? Okay, so this is the first chart I want you to be aware of. Okay, I think if you take a look at the S&P, it's likely gonna be the same thing, right? Let me just pull that up. Okay, so you can see that exactly the same thing, right? So it looks different, but the pattern is there, right? So just take note of that. Okay. Now with that understanding, okay, we talk about the dollar today as well. Okay, I want to show you two key charts on the dollar that I think you want to really pay very close attention to. Okay, so the first one here is on euro dollar. You can see some drawings over here based on Elliot Wave. Okay, the idea here is from this low back in March 2020, we do have that 5-wave move to the upside, and usually what comes next after a completed Elliot Wave 5 move is a 3-wave correction to the downside. Okay, and usually the correction will come back towards the wave 4 area. Okay, and I also included a fit over here. All of this comes very close together. Okay, so now we talk about how the dollar is likely going to weaken, right? But it's not going to go one direction. Okay, so it's not going to be like start weakening right now and then it's just going to weaken forever. Okay, in the currency market is always up, down, up, down, up, down, but generally you see a trend after that. Okay, so for the short term, I would see that maybe the dollar can do a rebound, okay, because it has been sold off for the entire 2020, right? You can see that, okay. So likely we're gonna see some rebound in the dollar. So when that happens, of course, your euro dollar here is gonna drop, okay. So for the short term here, I'm talking about perhaps about 2 to 3 months time, okay. If I do a time projection, likely up to, yeah, so this is up to like end of February. Okay, so maybe about 2-3 months period, we might continue to see the euro dollar drop. Okay, and I want to highlight this opportunity over here is because if you take a look at from where the current market price is, and I just do a very rough estimation to 1.16, okay, that is actually about 500 pips, okay, 500 pips of opportunity. Okay, and that to me is pretty significant, right? So you want to take a look at it. And I also did a quick analysis here on a 4-hour time frame. Likelihood of where you want to focus your potential sell is somewhere around this region. Okay, the price here is about 1.22. Okay, so maybe it's a bit small. I'll read it out. Okay, the price here is about 1.22. Okay, so you might want to keep an eye on that. Okay, that is the euro dollar. Okay, that's one huge opportunity that I'm personally paying very close attention to. The other one over here is the dollar yen. Okay, now for me, the dollar yen is something that I would say I would put it as trade of the year. Okay, when I say trade of the year means that it's one of the trade that you want to pay very, very, very close attention to. Okay, why I say that? Because if you take a look at this daily chart, okay, there's a very high possibility based on the technical patterns this can go up here. Okay, back to somewhere around 111.3. Okay, 111.3. So it's huge. Okay, it's huge. Take a look at this daily chart. Now, what can be the driver for the dollar yen to go up? It might not come from the US dollar. It might come from the yen. Okay, so if you understand, we talked about just now, right? Short term, because the Fed is printing money. Okay, it's in a very low interest rate environment. The liquidity is going to be flushed. Okay, there's a big high liquidity. What will happen is that when there's a high liquidity, we are in a risk-on environment. Okay, when we are in a risk-on environment, what it means is that traders and investors are willing to take a slightly higher risk for something that offers them a higher reward. Okay, and that's naturally one of the most common asset is your stock market. Okay, so to me, short term, yes, we might see the stock market correct, but moving forward towards maybe end of the year, I think it will continue rally. Okay, and if you understand risk flow, okay, risk on, risk off, which means that if money are flowing into higher risk asset like the stock market, then your yen, which is a safe haven currency, will weaken. Okay, so I think in terms of dollar yen over here, the main driver coming in can be the Japanese yen weakening. Okay, and I want you to keep a very close watch on this opportunity here. Okay, I'm not saying that this is 100%, but I'm saying that you want to pay very close attention to this opportunity. Okay, that move to the upside is almost close to 800 pips. Okay, it's almost close to 800 pips. And why I want to highlight this is because if you take a look at a lower time frame on the 4-hour time frame, the opportunity is really, really close. Okay, look at this here, right? We are at the bottom of this entire pattern. okay? And what do we have here, right? Even if you don't understand Elliot Wave, okay, this pattern, I think if you have a bit of technical knowledge before, you can identify it as a flagpole, okay? And usually when you see this combination here, you know, okay, the probability is to the upside, right? Okay, so you don't need any Elliot Wave knowledge as of now. Okay, another one here you can see is a mini one here, right? And this is the impulse pole. This is the correction that is potentially right now developing. Okay, so again, the opportunity is really near building up to it. I do have my own positions in the dollar yen as well. Okay, I wouldn't want to share with you like the exact entry and exit in this sharing here, because if today you do not have a proper strategy, a proper plan, don't have a proper understanding of risk management, and you just follow blindly, you know, enter and exit points like this, it's gonna harm you. Okay, so I wouldn't want to do that. Okay, but I just want to share with you the big picture direction. Okay, I'm personally looking at it. Okay, I have one position in the dollar yen already running, so we are looking at the upside. Okay, so this is huge. Okay, so this is one key opportunities I want you to keep an eye on. The last pair here before we go into the final portion of the sharing, and then of course Q&A. Okay, over here you can see is gold. Okay, which is commodities, right? Just now we talk about precious metal commodities. To me, I think gold has a big upside opportunity. Okay, but as of now, okay, again, right now the dollar is retracing, which means it's strengthening now. Okay, but big picture wise, maybe after February, March, likely you will see the dollar weakening again. Okay, so I've highlighted some key areas here that you want to keep an eye on for potential accumulation for gold. Okay, so the first one here, I'll put this text in. Okay, the first area that you want to pay a very close attention to is somewhere around 767. Okay, 1767. The other level that you want to pay very close attention to is 1648. Okay, so these are the two key zones that you want to keep an eye on for potential accumulation for gold. Okay, so you need to have a strategy, right? Today, I won't be able to share with you a full-fledged strategy because of time constraint and things like that. But you need to have a proper risk management before you execute this trade. Okay, so today is really to give you that opportunity so that you are aware of it. Okay, you can actually zoom in and focus on all this opportunity. So for me, gold, I'm looking to buy. Okay, I have already, of course, also one position running. Okay, the upside is basically huge. Okay, this is like almost the high that we have for the past few years. Okay, so there's really no absolute target right now. Okay, but I think if you're buying at a low, just manage your position, manage your trade accordingly. Okay, I think there's a lot of upside on gold itself. Okay, yeah. So let me bring you back to the last part of this presentation, and then I'll open up for Q&A. Okay, so over here, I will also give you some additional statistics to back up your trade ideas. Okay, so that's what I call it. And I feel that this is so important. Why? Again, you realize that I'm not only looking at one perspective whenever I analyze the market, right? We come from multiple approaches, right? Multi-prong. So you have like the global, you have the technical, you have the understanding of right now what I'm sharing with you is what we call seasonalities. Okay, seasonal trends. Okay, to give you a very quick and brief understanding of what is seasonal trend, we are basically looking at historical patterns based on time period. Okay, so if you first one here, right, you can see for the past 25 years, okay, this window of period between 5th of January to 24th of Feb, okay, for the past 25 years, we are looking at gold. It has a 76% of rallying. Okay, what it means is that for the past 25 years, you know, if you take out about 75%, that's about maybe close to, I don't know, 18, 19 years. Okay, so out of the last 25 years, 18 to 19 years gold rally, and of course the remaining year gold didn't rally. Okay, so to me, anything that is above like close to 80, that is pretty solid, right, in terms of statistics. And the average rally here is about 3.93. And of course, if you take a look at this year here, between 5th Jan to 24th of Feb, the upside is not that great, right? It's more like flat. Okay, so again, I want you to know these are not 100%, it's a probability thing. Okay, but how does this information going to help you? Okay, so you want to stack all this information together. So the idea here is, okay, if you're looking to buy, is the seasonal trend supporting you during that period? If you're looking to sell, is it a good seasonal trend supporting you? Is the global environment telling you that it's a good idea to buy or to sell? Okay, so this is how we stack them up. Okay, after this period here, you do have another window that you want to take note of in terms of the commodities. Okay, that's starting on 7th of July to 9th of October. So that's a 7, 8, 9, 10, 4 months period. Okay, it's a little bit low. It's about 60%, but the average return is pretty high. Okay, so how do you put this into practice? The idea here is we are looking at, just now I talked about it, right? Short term, dollar likely going to strengthen. So maybe you do not want to buy gold now, okay, but you want to keep an eye on it. And maybe when the time comes on the 7th of July, okay, and that's where maybe the dollar has done its rebound, it's likely going to fall again, it's going to drop, and vice versa, gold will rally, right? So you want to keep an eye maybe on the 7th of July, you want to see, okay, go back to your technical chart. Is gold around the key buy zone that I want to look out for? Do I want to accumulate right now? Then on the 7th of July, maybe around that period there, give and take a few days, okay, you might want to get involved in gold. Okay, so that's how you use this trend, right? How you use this seasonality trend. Okay, silver here also have its trend, of course. You can see from 8th of Jan to 21st of Feb, there's a high chance that it's going to rally. The next one comes about 28th of June, okay, until 3rd of Feb. Okay, again, all this information will be given to you in the slide. You can download it at the end of this webinar. I'll give you a link. Okay, so don't need to worry about like copying down everything of this. Okay, but the idea here is you get all this information. The important part is I want you to be aware of how you can utilize it. Okay, so just now I mentioned, right, for gold example, that's how you can use it. Okay, so all this research here, I've done it for you. Okay, copper as well. You want to keep an eye on copper, right? Copper is basically a commodities, a metal that is what we call a leading indicator for the economy. In other words, if copper rally, likely your economy is growing, okay, it's improving. If copper drops, your economy is not a good sign, okay. And when we talk about, just now we talk about fiscal policy, right? Government spending on infrastructure, upgrading, construction, and things like that. A lot of all this industry will use copper, okay. So the demand of copper will shoot up. Okay, so of course, right now we are in the trend, in the seasonal trend. The next one comes around 22nd of June. Okay, so I think for the precious metal, right, you want to ignore the first seasonal trend, okay, because we are already quite close to the end of it. But you want to take note of the new upcoming trend, which is like from 22nd to June to 31st of July. That's about 1 month. Okay, but the 1 month copper actually rallied by 4%. That's pretty significant. Okay, so all this information is given to you, just make full use of it. Okay, of course, oil over here as well. Okay, this is already right now pretty much happening. And the next one here is actually 18th of March to 21st of May. Okay, so this is just a few days here. But oil is another one that you want to keep a close watch with, because when there's fiscal policy happening, oil is another commodity that is on high demand. Okay, so do take note of this. Just that moving forward, perhaps one of the largest competitor in oil is your renewable energy. I think that's a new trend coming up as well. Okay, a lot of like topics and conversation about electric, clean tech. Okay, and I strongly believe that renewable energy, green tech, and clean tech, okay, will be the new trend. Okay, so keep an eye on those sectors as well. Okay, just name a few companies. I believe, right? Of course, the one that I'm personally looking out for is NextEra Energy. Okay, that's I think one solid company you want to pay attention to. Okay, even currency, right? We talked about just now looking at the charts. They do have seasonality trends as well. Okay, so all this information here, I think I don't need to read out. Okay, you guys are intelligent enough to interpret it once you learn how to understand this information. Okay, even on dollar yen. Okay, so all these are given to you. Okay, and of course the Nasdaq here as well, right? We talk about it. Okay, so I want you to pay attention to where we are right now. Okay, this period is very close, right? It's very close. There's a huge chance that we'll see a correction. Okay, it's not a crash, but it's potential correction. The next correction that you want to keep an eye on is 17th of July to 8th of October. Okay, the percentage of drop is not that high. It's only 40% that it will drop, but the average here is negative. In other words, when it drops hard. Okay, so the idea here to give you that idea how to interpret this, right? So if you take like 10 times, okay, 10 years, okay, 40% decline means 4 years drop, 6 years rally. Okay, but out of this 4 drop and 6 rally, if you average out, okay, you get a negative 1.4. Okay, in other words, this drop here is so big that the recovery of that 6 years didn't really help to cover the losses. Okay, that's what it means. Okay, so do take note of that. Okay, be aware of these periods over here if you're looking at the stock market. Okay, but generally, long run, the stock market is always going up, right? That's how the index works. Okay, so this is the part. Okay, before we go into like how you can get the slides, I will open up the remaining time, okay, for Q&A. Okay, let me just do a very quick check if there's any question. Oh, okay, so I'll read out the question. Okay, it might not be in sequence, okay, because I think the platform here might not be direct, okay, but I'll try to answer as many questions as you can. Okay, so the question here by Jojo, okay, asked was, when do you expect the stock market to start its correction? All right. Okay, I would use the chart here to give you the element of time. Okay, because the global market environment already tells us that starting January you want to be cautious, right? From 5 liquidity to 0 liquidity. That's where I already want to be telling us to be cautious. Okay, now if you take a look at this chart here on Nasdaq, okay, need to cover a little bit on what I say, what I meant by Elliot Wave. Okay, so to understand that, okay, let me bring up my pen too. Usually an ending diagonal would have 5 moves inside it. Okay, so how it looks like is like 1, 2, 3, 4, 5. That forms your ending diagonal, and then this is where it likely gonna drop. Okay, so if you really go and take a look into it, we are potentially seeing that already. Okay, of course my drawing doesn't do its like good way of doing it, the interpreting the information to you, right? But if you take a look at his, okay, this is where the most recent low is, not this, right? This one, this is lower. Okay, so this is like the most recent significant low. Okay, and you start to see how many times this actually moved up in a wave. Okay, 1, 2, 3, 4, and of course this is an overstretched move to the upside. Okay, and usually how we draw our trend line, okay, you can see that's how I did it. Okay, of course I can do it something like this. You can see we are at the very top right now. Okay, I don't want you to have the impression that I'm just trading the trend line. No, okay, this trend line again is just draw in for visual purposes. Okay, but I feel that we are really getting very close to a potential correction. Okay, I'm personally already very cautious in my stock portfolio. Okay, but I want you to be aware that it doesn't drop one day like that. Okay, like unlikely is going to be happening like that. Okay, in other words, you might have the opportunity to get out when you first see a bearish candle, I would say. Okay, so you look at this, right? This is where it happens back in March. It gives you 3 days of warning sign. Okay, so if over here you see, okay, 1 time, 2 time, 3 time, it seems like it's breaking this low. Okay, that's where you want to pay attention to it, and perhaps that's the start of the correction. Okay, of course I can't give you an exact date and time, right? If I can, then I will have a crystal ball and then I'll be like the prophecy, but no traders can. Okay, no traders can give you that exact time, but the chart here can give you a good guidance. Okay, so the idea here is, again, you see this trend line here, right? Maybe you go to your chart, you just draw this trend line up, and then if you see that it's coming down, it's breaking off this trend line, it's a good time to tell you that perhaps the correction to the downside is starting. Okay, okay, let's see some other question. Oh, okay, I see one from Cindy. Okay, so Cindy actually asked the chart for the price chart for silver. Okay, let me open up that. Okay, silver and gold is pretty much similar in a way. Okay, so this is daily chart, right? If I bring you to like gold daily chart, okay, you can see this is the downward correction. Okay, so on silver is also the same. Okay, so if I give you my opinion and of course my analysis quickly over here, I personally feel that you do not want to buy now. Same thing as gold. Okay, there's a possibility that you might see this move down here. I'll draw a horizontal line stick. Okay, there's a high possibility you see silver, okay, coming back down towards this area, okay, and that's about $21.80. Okay, so that will be a good place for you to perhaps accumulate silver. Okay, I do have two positions running now. Okay, of course, that was like way back last year. Okay, but if it comes down towards somewhere around this zone here, around 21, I think it's a very good area to accumulate some silver. Okay, it's actually the same idea with gold, right? Let me bring you back to the chart over here. You can see if it drops and come down towards this zone here for the first area. Okay, this area here, that's a good area to accumulate for your first position. Okay, so same thing in silver. Okay, if it drops towards this low here, I think that will be a good area to start accumulating. Now, if I show you on the okay, I might, okay, good. I have the data on here, right? So if you take a look at the monthly chart, right, silver actually went as high as this price here is about close to $48 back in 2010, 2011. Okay, I want to give you this perspective, right? 2008, that's where the global financial crisis happened. 2009, the Fed starts printing money. So again, what will happen when a lot of money is printed? Your dollar valuation will go down. 2010, this happened. Okay, so put that into the perspective of where we are right now. 2020, we have a crash. The Fed starts printing money. Maybe by 2021, second half of the year, going into 2022, this can happen. Okay, now I'm not saying it's definitely going to happen. I'm showing you what happened in the past. There's this high possibility that history repeats itself. Okay, so do pay very close attention to the commodities market. Okay, so platinum, gold, silver, I'm in this tree. Okay, so silver I have two positions, platinum I have one, gold I have one. Okay, so this is something that I hope it helps, right? Hope I answer your question, Cindy. Okay, good. Okay, so if you have any question, put it in. Okay, so I'll take a look at that. How here asks, for market correction, are you referring to KLSE or Dow Jones? Okay. Now, very good question. How? I need to share this first. Okay. I personally don't trade the Malaysia market. Okay. I personally feel that the opportunity is just not there. Okay. Of course, I know traders, investors who make money from Malaysia market, but why would I? If the US offer me so much opportunity, why would I go to Malaysia, right? So I'm referring to Dow Jones here. Of course, when I talk about Nasdaq, we are referring to Dow Jones. We are referring to the S&P. Okay, US in general. And when the global market corrects, okay, I don't think Malaysia KLSE will rally. Okay, likely it also corrects. Okay, so yeah, okay, and if you take a look at it, okay, just look at 2020. I might not have the chart on KLSE, but based on what I know, the US index hits all-time high. But if you go and take a look at the chart of KLSE, you probably never even reach another high, right? An all-time high. Okay, so that already straight away tells you the different potential in the different market. Okay, so in short, when I'm talking about Nasdaq over here, I'm referring to the US market. But when the US market correct, there's very high chance globally Malaysia will also correct. Okay, okay, good. I hope I answered your question. Wong here asks, what is my view on Bitcoin? Okay, now I feel that yes, it's a very good time for us to monitor Bitcoin. I think Chrissy also asked a question: how will Bitcoin replace gold, affect gold trading? Now, first off, I don't think Okay, I don't think gold will replace Bitcoin will replace gold. Okay, I still feel that Bitcoin is in a very early stage. Okay, but you definitely want to pay very close attention to that, because the big boys are coming in. Okay, when I meant big boys, I'm not talking about your retail traders. I'm talking about companies like asset management. Okay, if you read the article or follow the news, recently BlackRock, which is the largest asset manager in the world, right? They started to go into Bitcoin, right? So they set up some departments to start being involved in Bitcoin. Okay, so I think with that, that's where it starts to get a little bit more interesting. Okay, and you want to start paying a bit closer attention to this particular market. Okay, my view on this is that I'm definitely not going to be trading it short term because it's a very volatile instrument. Okay, not anyone can take it, right? It drops like 40% in a single day or two. Imagine you invested into that and then your position drops by 50%. Okay, you probably won't be able to sleep very well. Okay, so you wouldn't want to go in and out and trade it. Okay, that's something I won't encourage and I won't do it. But if you're looking for long-term investment, yes, okay, the opportunity I think is there. Okay, and if you apply this chart here and then I just apply some analysis, right? Very quickly, you actually can see it looks quite similar, to be honest. Okay, with what you see in your commodities chart. Can you see that? Okay, okay, the scale might be different, but the pattern looks the same, right? Gold, this is coming down after a move to the upside. Take a look at Bitcoin here. Okay, it's moving up and then it's coming down. Okay, so to me, I'm not gonna buy yet. Okay, honestly, it's still early stage based on my definition here as big boys are coming in, right? So I will continue to monitor it. That's for sure. I think there's a lot of opportunity, but short-term wise, unless you have a high risk tolerance, don't touch it. Okay, so that's the suggestion I can give you, right? Okay, Tay asks, what is the trading charting platform you are showing us now that you are using? It's Phillips Futures MT5 platform, guys. Okay, so I think if you have an account with Phillips Futures, you just need to go and download the MT5 platform. Okay, it looks similar to MT4, right? But it's just the newer version. It's called MT5. Okay. I believe Phillips Futures probably will have some webinar that teaches you how to use the MT5 platform. Maybe Sri can correct me if I'm wrong. Okay, but I believe they do have some webinars that they teach you how to use this platform. Okay, you can download it on their website as well. Okay, Chrissy also asked another question. Okay, for time issue, right? Maybe I'll keep it to like the last 3 questions. If you guys have, right, just type it in. I will answer the last few questions. Okay, Chrissy over here asks, for clean and green tech, what are your views on ETF? Yes, okay. To give you a very quick and short answer, I think investing into ETF is a good approach if you do not want to go and do like individual company research or even stock pick. Okay, so basically you just invest into ETF, right? That's a good approach, okay? Especially if you do not have a lot of time to do research, you do not want to have the hassle to kind of like follow through in the market, then what you do is you just invest in the ETF that's related to the green tech industry that you want, right? But there's pro and cons, right? Of course, the advantage here is you do need to do a lot of work. You basically follow whatever the ETF is buying, okay? But the downside here, of course, is that the ETF is not likely okay, in other words, let me rephrase that. The downside here is that if you compare it to you doing stock picking, okay, you might perform better than the ETF. Okay, so that's the disadvantage of investing in an ETF, lah. Okay, but you need to assess whether you have, number one, the knowledge, the research, the time to really do that. If not, then a good option is definitely invest in ETF. Okay, speaking of that, I think right now like ARK Invest ETF is like gaining huge popularity in the market, right? So just giving you some my thoughts on that. Just be cautious, okay? I feel that the whole thing is starting to turn a little bit into like a hype and maybe a little bit of self-fulfilling prophecy. Okay, and I recently Bloomberg or even CNBC actually released an article. I'm not sure if you guys actually saw it, but I think you can just Google it, right? Keywords includes like ARK, ETF, maybe too big. Okay, so the article in short, what it's talking about is that when an ETF is gaining too much traction, meaning a lot of interest coming in, right? A lot of investors putting in the fund, investing into it, they might have a certain challenges moving forward. Okay, now you realize that 2020 their performance was crazy, right? Was fantastic. Okay, because they are maybe still small, they are able to move around in the market. They're still being able to be nimble, right? Getting in and out. But as an ETF starts to grow, there's certain mandates they need to follow and things like that. I don't think if ARK continues to grow at this pace, they will be able to perform like 20% every year. Okay, so you want to take note of that. Have the expectation. Now, I'm not saying that it's a bad investment, but have that expectation, because I see a lot of retail investors jumping into it, expecting that every year they'll grow, you know, their portfolio by 20% just by investing in ARK ETF. Okay, you might not see that performance moving forward. Okay, just have your expectations set out properly. Okay, so I hope that also give you a bit of different perspective into that. Good. Okay, hope so far so good, and today's presentation is clear. I almost forgot. Okay, you guys never really asked this also. Okay, you can download the entire slide deck over here. Okay, so instead of like sending out to each of you, one of you, I've automate the entire process. You just go over to this website here that you see on the slide. Okay, just key in your name and email. You will receive that email with the entire slide deck. Okay, so you'll be able to download all this information that we talk about. Of course, all this seasonality statistics, right? We scan through pretty quickly. So yeah, you'll be able to download all this, the entire, whatever you see today, you'll be able to download it. Okay, so that's in short. Good. Okay, so with that, okay, we have that Q&A session ready. Okay, so with that, I really hope that today's sharing actually benefited you, importantly give you a different perspective into the financial market. Hopefully it's able to protect you, and of course, on top of just protection, you guys actually saw the opportunities available. Okay, I want to always highlight, right? A lot of people they like numbers, right? They like to have a lot of opportunity, but I want you to be able to see that you don't need that. You just need quality one. Okay, so I want you to just imagine, right? In the year of 2021, if you can ride the dollar yen trade, if let's say this really plays out like that and it goes up, and you are able to ride it, okay, isn't that fantastic? Okay, my webcam runs out of battery, so you won't be able to see me right now. Okay, but you can hear me, you can still see my slide, right? My computer, my camera went out of battery. Over here. Okay, so yeah, so I hope it helps. Okay, and of course, I think just now some of you asked if this is gonna be safe as replay. Yes. Okay, and of course, do share with us the feedback. Okay, what you learned from this session, what you like about it, so that I also can improve. Okay, as we progress. Okay, and I think there will be another webinar that we'll have on February, okay, where we talk about global indices. Okay, so again, I share with you the different perspective of if today you want to trade indices, what are some of the things, what are the methods of analysis you can put in place. All right, so that's all from me over here today. Really hope you guys enjoy it, okay, and more importantly, learn something from here. Okay, so once again, I'd like to thank Phillip Futures for giving me the opportunity. Okay, then I'll pass the time back to you.
Thank you so much for giving us these wonderful insights, as well as where the opportunities are in the year ahead. If you have enjoyed viewing the platform as well as the charts that Kar Yong showed you earlier, you can also request a demo using the QR codes or QR code to the far left, rather, on your screen right now. Phillip Futures offers zero commission trading of forex, stock, share CFD, stock indices CFD, as well as commodities CFD. So just give the platform a try, and apart from the platform, you also gain the value-added tools like auto chartists, as well as Trading Central technical indicators. And recently, we added Trading Central's Market Buzz as well, so you can keep track of what's buzzing amongst the investing community around the world. Okay, if you have any other questions or if you have enjoyed Kar Yong's webinar, please let us know in the feedback form. If you liked this cap that you had on today, please let us know as well. I'll be sure to forward the feedback to you. And once again, thank you for being a wonderful audience. We'll catch you in our next live webinar. And as you've heard from Kar Yong, we'll be having another webinar coming up real soon. Details will be announced very shortly. All right. So we'll talk to you soon. Catch you in our next live webinar. And thank you, Kar Yong.
Right,
Have a
see you
good night.
guys. Bye bye.
Take care. Bye bye.